Your rent just went up. Your car payment doubled. Your parents can't afford a house anymore. And somewhere in Washington, a room full of people you've never met just decided all of that by moving a single number. Most people think the economy just happens to them, like weather. Gas gets expensive, so you complain. Houses become unaffordable, so you rent longer. Your savings account pays you nothing, so you shrug and leave your money there anyway. You think you're powerless. I used to think the same thing. I watched my first apartment rent jump 40% in 2 years. I watched my dad's construction business lose half its contracts in 6 months, and I had no idea why. I just thought that's how things worked. Random, unpredictable, out of my control. So I started digging. I read boring Federal Reserve meeting notes. I tracked housing data. I compared credit card rates to mortgage rates to business loan rates. I looked at what happened in 2008, what happened in the 1980s, what happened last year, and I realized something disturbing. None of it was random. Every single financial decision that touched my life, from grocery prices to whether my neighbor could start a business, came back to one thing: a number that 8 people vote on 8 times a year in a building most Americans couldn't find on a map. The reason most people don't understand how interest rates work isn't because they're stupid. It's because the system is deliberately complex. It hides in plain sight, and the people who benefit from you not understanding it would prefer you stay confused. All right, let's say you're 5 years old. You want a toy that costs $20, but you only have 10. So you ask your mom to lend you the other 10. She says yes, but there's a catch. You have to pay her back $11 next week. That extra dollar, that's interest. Now let's say your mom is having a great month. She's feeling generous. She tells you, actually, you only have to pay me back $10.10. Suddenly, borrowing money is cheap, so you borrow more. You buy the toy, you buy candy, you buy a book. You're spending like crazy because the cost of borrowing is almost nothing. But then, let's say your mom gets worried. You're buying too much stuff. The house is full of junk. You're not saving anything.
Look at all
so
these
she
coins.
changes the deal.
They're multiplying.
Now, if you want to borrow $10, you have to pay
that's
back
a lot of
15.
books. I can do
Overnight,
this.
borrowing
Almost
becomes
there.
expensive. So
I
you
made
stop.
it.
You save your allowance. You only buy what you need. That's exactly what the Federal Reserve does. Except instead of your mom, it's the central bank of the United States. And instead of you, it's every person, every business, every bank in the country. The Fed sets the cost of borrowing money, and that cost touches everything. When interest rates are low, borrowing is cheap. So people take out loans to buy houses, companies borrow to expand, banks lend aggressively because they're competing for business. More money flows into the economy. People spend more, prices go up, jobs get created. Everything feels good until it doesn't. Because when too much money chases the same amount of stuff, inflation spirals. That's where the party ends. So the Fed steps in. It raises interest rates. Suddenly, your mortgage costs more. Your credit card payment doubles.
Let's build!
That business loan
Yeah,
your friend
let's
wanted
fix
to
it!
start his company,
Painting time!
he can't
We
afford
can
it
do it!
anymore. Banks get cautious. Spending slows. Hiring freezes. The economy cools off. Inflation drops. But so does everything else. Growth, opportunity, optimism. Here's the part they don't tell you in school. The Fed is always guessing. They don't have a crystal ball. They're looking at data that's already weeks old, trying to predict what 12 months from now will look like. They raise rates too fast, they trigger a recession. They raise them too slow, inflation eats everyone's savings. There's no perfect answer, just trade-offs. Let me give you a real example. In 2008, the housing market collapsed. Banks stopped lending, people lost their jobs. The Fed panicked and dropped interest rates to basically zero. They kept them there for years. The idea was simple: make borrowing so cheap that people have no choice but to spend and invest. And it worked, sort of. The stock market exploded, housing prices came back, unemployment dropped faster than anyone predicted. But here's the uncomfortable part. That cheap money didn't go to everyone equally. If you already owned a house, your wealth doubled. If you had stocks, you got rich. But if you were young, just starting out, trying to buy your first home, you got priced out because everyone with access to cheap loans was bidding against you. The very policy designed to help the economy made inequality worse. Fast forward to 2020, pandemic hits, economy shuts down. The Fed drops rates to zero again, floods the system with money, stimulus checks, loan forgiveness, free cash everywhere. And for a while, it feels like magic. People are spending, the stock market hits record highs, unemployment falls faster than anyone predicted. But then reality shows up. Inflation hits levels not seen in 40 years. So in 2022, the Fed does what it always does. It slams the brakes, raises rates faster than any time in modern history, from near zero to over 5% in less than 2 years. Mortgages that were 3% are now 7%, car loans double, credit card debt becomes a trap, and millions of people who bought houses or started businesses during the cheap money era are now stuck. They can't refinance, they can't sell, they're frozen. Here's what makes this so brutal. Interest rates don't just affect you when you borrow, they affect whether you can get a job, because when rates go up, companies stop hiring. They affect your rent, because when landlords' mortgage costs rise, they pass it to you. They affect your groceries, because supply chains run on credit. Everything is connected, and the connector is that one number. Now let's talk about what happens next, because this is where it gets weird. The Fed wants to lower rates again. Inflation is cooling. The economy is slowing. Technically, they should cut, but they're terrified. If they cut too soon, inflation roars back. If they wait too long, businesses collapse. They're trapped in a cage they built themselves. And every decision they make creates winners and losers. Someone always pays. You want to know who wins when interest rates are high? Savers, people with cash, retirees living on fixed income from bonds, banks that can charge more to lend. You want to know who loses? Anyone with debt, first-time home buyers, small businesses that need loans to survive, young people trying to build wealth. The system doesn't care about fairness, it cares about control. And here's the really uncomfortable truth. The Federal Reserve is not elected. You didn't vote for Jerome Powell. You can't fire him. He and 8 other people have more control over your financial future than almost any politician. They meet in private, they debate in secret, and then they announce a number, and that number rearranges your entire life. So the next time someone tells you the economy is doing great, ask them one question: great for who? Because when interest rates move, someone is always winning and someone is always losing. The game is rigged, not by conspiracy, but by design. And the only way to stop being a pawn is to understand the board. Interest rates control everything: your rent, your salary, your future. And the people who set them are betting on an outcome they can't guarantee. Maybe that should scare you. Maybe it already does. So here's my question for you. Do you actually know what happens when the Federal Reserve changes interest rates? Not the textbook answer, the real one. Drop a comment if you think you do. Let's see how close you are.